Makes it quicker to download too. if I do that. Okay, so allocation of rental expenses. Well, oh, actually, okay, step back. We're still talking about the rental slash personal in this section. So there are two ways, when it's a personal slash rental property, there are two different ways to allocate expenses between personal use and rental use. Obviously, any direct expenses attributable to renting the property, those would be 100% deductible against the rental income. However, we have items like insurance that you pay for all year long, whether you're there or not. Mortgage interest, which you pay for all year long, whether you're there or not. Property taxes, which again, you pay for all year long, whether you're there or not. And then we have items like utilities, that the usage, so we're talking about variable versus fixed costs here. Utilities, which would vary depending upon whether somebody's in the home or not in the home. There are a couple of different ways that we can allocate expenses when it's a personal slash rental property, okay? One is called the IRS method. And the expenses here are allocated between personal and rental days based on the ratio of the number of rental days to the total number of days used. So the denominator could be smaller than 365 in this case, right? So because if you're using it for personal purposes for 20 days and rental purposes for 30 days, your denominator is going to be 50 in that case. Okay, I'll show you. We'll go through some examples here. The other method is called the tax court method. And what they do is the interest in taxes, which are paid all year long regardless of whether it's being used, are allocated based on the ratio of the number of rental days to the total number of days in a year, 365, or 366 if it's a leap year. The remaining rental expenses are allocated using this first method. So the only time the tax court method, the only expenses that we would use this tax court method with, dividing by 365, is mortgage interest and property taxes, because they're paid throughout the year. I don't know why they don't include insurance in that. Maybe they presume that you're going to have separate insurance for it when you're renting it, but court's rationale is that interest and taxes occur ratably over the entire year, whereas other expenses occur only when the property is used. Certain expenses are deducted in full, so these would be expenses that have no personal element, travel costs, management fees, anything directly related to rental of the property. As I mentioned here, the tax court method nearly always results in a larger deduction. So also the expenses have to be deducted in a certain order, because remember, we can't go below 0. Anytime we can't go below 0 on something, like with that home office deduction, we have to do things in a certain order, okay? First, mortgage interest and property taxes, and those expenses that are directly related to the rental activity are deducted. Next, our indirect expenses, like utilities, insurance, and repairs. Last is depreciation, if there's any remaining, right? Deducted only to the extent that there is still income remaining. So let's look at an example here of how this works. So, same rental property, was that the Masters? Yeah. So rental income is $21,600. Taxpayer used the property for 22 days for personal use and rented it for 84 days. So they did the math for us, and they know it's personal slash rental. So now we're going to look at the two different ways of allocating these expenses. Assume the property was held the entire year when using the tax court method, because if it's not used the entire year, then we're not going to be dividing it by 365. We're going to be dividing it by however many days we actually owned it, right? We're not going to use 365 then. So here's these are our total expenses: mortgage interest, property taxes, travel. This is a direct expense here. This would be an indirect. Management fees would be a direct expense. Insurance would be an indirect expense. Utilities, indirect. depreciation, that comes last. All right, using the IRS method, we're gonna take the mortgage interest of $1,300. We used it 84 days for rental days. Is that for rental days? 84, yeah, rental days. 84 over 106. Where do we get 106? That's the total number of days it was used. Rental days plus personal days. Okay? And this gets us our rental and personal expense. So, mortgage interest, this is going to go on the Schedule E. The rest of it's going to go on the Schedule A as a deduction if we have enough itemized deductions to take that. Property taxes, same thing, 84 over 106. So 84 days, rental days over total days used of 106. Even though that mortgage interest and property taxes were actually for the full year. In this case, we get to use 106 as the denominator. You can see that we're going to get a larger number here than we would if we were dividing it by 365, right? Management fees, we get 100%, that's a direct expense. Travel, again, 100%, that's also direct. The rest of these are indirect expenses, and then the depreciation, our depreciation is going to be limited because if you look at the math, so we've got 21,000, what was it, 21,600 was the income. And we subtract, somebody else can do the math. What's this, whoops, well, this is these are probably, how much is all of this before the depreciation? $11,750. 15. Okay, so if we subtract that, so 5, 9, 1, 5, 8, 8, 9, whoops, 9, 885, 9885. So we can only take 9885 of depreciation because we can't go below 0. Okay. That is, which method is this? That's the IRS method. Tax court method. Now we're gonna still end up at 0, but it means we get to take more depreciation. Because the only difference is mortgage interest and property taxes. Now the denominator is 365 to determine the ratio of personal to rental. Okay, so now we've got more personal. Actually, this is probably going to end up a better deal for them if they itemize their deductions. If they itemize their deductions on Schedule A, they're going to save more money using this method because they're still going to end up at 0, right? They're going to have no income, no taxable income from this rental, but they have more deduction on their Schedule A because now more of those were passed over to the Schedule A. So up here, you can see their total deduction. So 0 here, the 270 plus the 789. But here on their Schedule A, they get almost $4,000 of deduction. Does that make sense? So the Schedule E is going to be 0 either way, no income. But the Schedule A is going to have more deduction using this method because more of it was allocated to the Schedule A. All right, multifamily homes. Any questions on the vacation slash personal and allocating between those two. IRS method versus tax court method. Do that stuff? Okay. Let me get through this real quick. So multifamily residential homes, we have to allocate based on square footage, just like we did with the home office deduction. Here's an example. Guadalupe owns and lives in a fourplex, identical 2-bedroom units in Anaheim, California. The entire fourplex at $100,000 in expenses. She's going to allocate 3/4 of the expenses, so I'm assuming she lives in 1/4 of it. 3/4 of the expenses, and she gets to deduct $75,000 of the rental expenses against rental income. The remaining $25,000 would be considered personal and deducted to the extent that she can take it if she itemizes. So if it's mortgage interest or property taxes, she might be able to take some of that if she itemizes her deductions. But if not, she's not gonna be able to take the rest of that. Okay, so we looked at this. Let's see. This is another vacation slash personal. So for example, let's say we have a home, rental income of $50,000, and it is a duplex, and the rental portion is 1,200 square feet, and the personal portion is 1,800 square feet. We had mortgage interest of $7,500. We had property taxes of $5,000, and we had other rental expenses. These are just rental of, say, $20,000. So our rental income, 100% of that, obviously, here's our Schedule E. So 100% of the income is rental. That's its rental income. So $50,000 for the income. Now, we've got to figure out what percentage of these items would be rental. 100% of these are going to be rental because it says it's just for the rental property. These are expenses that only relate to the rental property. So, other rental expenses, $20,000. But these, add these together, so 3,000 total square feet. To get the rental portion, we're going to take 1,200 divided by 3,000. How much is that? What percent? 0.4. Okay, so 40%.
Yeah.
All right, so 40% of our mortgage interest and 40% of our property taxes are going to be rental expenses. The rest of them are going to go on the Schedule A because part of it was used for rental, 40% was used for rental, the rest of it was used for personal purposes. Does that make sense? So what, 40% for, is that 3,000? So this one's 3,000. I know this is kind of a hot mess here. And this is 2,000. So our net rental income then, 25,000 would be our net rental income. That's what we'd be taxed on. Does that make sense? We're just apportioning those expenses that are attributable to the entire property. We are apportioning between rental and personal. Okay? Right. Questions? Okay. So let's